Hi everyone, my name is Deepak. I work out of Keller Williams Santa Clara office. As I already told you, this is my almost towards the end of my second year in real estate. All my last 2 years have been with the Santa Clara office, amazing people. Just ask for help and you get it. I've been having a lot of fun in real estate. Before this, I was in software. And how I got into real estate is I bought my first primary home, single family home, just across the street here on Agnew Road, 2012. And I realized the benefits of owning real estate through that. When I bought it, it was the house which sold for the maximum price in that neighborhood in the last 4 years, because the 4 years before that were 2008, 2009, 2010, and 2011. So I also had buyer's remorse for a few months. But starting 2013, when I saw the value going like this, I was like, I made a great, what a genius, right? So that made me really interested in real estate. I realized the benefits. I'll tell you a quick story. I've told this story many times. 6 years before that, since I came to Bay Area, I somehow managed to save 100K and put towards the down payment of that house. The next 6 years, 2012 to 2018, the house added 100K to itself every year. And this is me still doing my full-time job. This is passive income, passive equity that's building up. And when I sold it, married filing jointly, 500K of equity gain is no tax. Even while I was owning the home, there is a tax break that you get on the interest portion of the mortgage, and there is a tax break that you get on the property tax, right? And then while you own the home, if you see your home value going up, you can always do a cash out refinance, get that cash out and invest it somewhere. There is absolutely no taxes on cash out refinance. So those are the advantages that I realized as a homeowner in the Bay Area. So it made me very clear in my mind that I have to be associated with real estate for the rest of my life. I was just not sure how. So the obvious thought that comes to your mind is, hey, become a realtor. But I was on work visa, and coming from India, it takes 87 years to get your green card, theoretically. Yeah. I got lucky, I got it in only 12 because I did masters from here. So I got bumped up, so only 12 years. But then I was like, I cannot wait forever. Time is money. So I started reading books, educating myself, and that's how I got into real estate investing. And that's what the presentation is about. I got into real estate investing around 2018. I eventually got my green card before I became 60 years old in 2021. But those 3 or 4 years confirmed me my love for real estate. And I was absolutely clear in my mind that this is what I really want to do. First 1 year, I started in April 2022. So first 1 year, I did both engineering and real estate, but my lead funnel was growing at a pace that I was hitting a ceiling in terms of my time availability. And this is what I wanted to focus on and expand in future. I anyways wanted to fade out my engineering job. So starting March of 2023, I'm a realtor full-time. So I find this discussion or this class really valuable. I wish it is done more often across the brokerages, because this opens so many more avenues for us, especially when we are new agents, that we always think of primary home buying or selling, but we do not think much about investor clients. However, if you can have a conversation with your investor clients, that, as I said, it just opens so many more doors for you. Last year was a very tough year for real estate. There wasn't much inventory. There were times where there were not too many buyers for the primary homes as well. But there are always investors looking for deals. They have cash, they are doing 50% down, they are doing 100% down. As long as they can get a good deal, the interest rate does not matter much. And when I started as an investor, I did not realize this, but I gained some skills which were helping me in that tough year as a realtor. I was able to still do deals because almost half of my deals were investor deals. So I just wanted to thank you to Travis for giving me this opportunity. And I wanted to just share some pointers with you. I would not be going in depth into anyone, but we can always have conversations later. You can always take me out for boba and I'll be happy. That's the only fee I charge. But I'll be happy to partner with you on any investor deals if you like. And I invest in and around Bay Area, depending on the price points and the numbers, so we can have the discussion accordingly. So with that said, I'll move on to the next slide. The very first thing when somebody, sorry, am I in your way? Okay. Very first thing when somebody talks to you, hey, I want to invest. So you ask them, what is your motivation? Are you looking for appreciation, which is pretty much cash on cash, like this much appreciation, like this much you put in and this much you get in return? Or you're looking for a cash flow. Cash flow is a constant stream of income that ends up in your bank account week after week, month after month, year after year. And then what is your risk tolerance? How much are you looking to invest for 2 years, 3 years, 5 years? This is not day trading. We are not buying the Tesla stock today and selling it tomorrow or the next week. Real estate is a long-term game. They say you do not wait and buy in real estate, you buy and wait. Okay. Anybody who does not know the difference between appreciation and cash flow, I can go in more detail. Feel free to ask any questions. No question is a stupid question. This is a safe space. Yeah. Right. Increase in value. I just say this, cash flow keeps you going, appreciation makes you rich or builds you wealth. That's the right way. Builds you wealth. Okay. There are different investors have different criteria, especially when it comes to Bay Area. Bay Area is all appreciation game because our rents have not caught up with our prices. Our prices just keep going up, but the rents cannot go up with that pace because the people who are renting, they're renting because they cannot afford the down payment, right? Which also means they cannot afford the percentage increase at which the prices are increasing. So when somebody is buying in Bay Area, they are looking more at appreciation and less at cash flow. However, when I started investing, I had some money to spare, so I could not afford to buy in Bay Area. I started looking outside Bay Area. And as an engineer, I just analyze data and look at patterns pretty much all the time. I can't help it. That just comes as second nature when you are an engineer for almost 2 decades. So when I came to Bay Area, I think in 2006, that time we used to say, oh, you live in Fremont, that's close to Bay Area. Today we say, oh, you live in Danville, you are in Bay Area. Wow, right? So the definition of Bay Area keeps changing. That concentric circle keeps growing. So I think if I buy just outside a very hot area, someday it's gonna catch that fire and the prices will go up. So I started going slightly outside Bay Area and see where my numbers will work. By numbers, I mean, for an investment property, when you buy it, typically most lenders require 25% down. So with the 25% down, would my rent be able to cover PITI? Does anybody know what a PITI is?
My goodness. Yeah, tax.
And?
Interest.
Thank you. Teamwork. Yeah. So is my rent able to cover principal, interest, which is the mortgage, and then tax and insurance? There are more costs. If I always have a property manager, I always believe in offloading the work to the professionals who are the specialists in it. Then you have maintenance. But if your rent can take care of your PITI, for me, I'm good. I do not necessarily need a positive cash flow up at the front, but as long as I can break even or almost break even, I'm okay. Because guess what? Your rents are only going to go up with time. Your mortgage is not going to change unless you have a very aggressive ARM loan. And everybody knows what an ARM loan is, right? Okay, almost. Feel free to ask questions at any time, guys. But your mortgage might go down if the interest rates drop and you refinance, right? But your rents will go up. So an equation which looks break even today will turn positive tomorrow. So I'm okay if I'm breaking even or I'm $100 or $200 negative cash flow per month. So that's how I ended up buying my first property. And then even in that, and that was in Antioch. And that area saw so much appreciation. My prediction was right, but then the pandemic also happened soon after, and I turned out to be a genius again. And then by the time I was ready to buy a second investment property, that area went up like 30-40%. So the numbers did not make sense for me anymore. So I started going further out, and that's how I ended up in Sacramento Valley. And till date, I'm investing in Sacramento Valley. Having said that, doesn't mean there are not other areas which are good for investment, but that is just my criteria. Talking about the motivation, you also have to discuss with them what is the cash available. Like right away, people will say, oh, I really want to invest in real estate, but all I have is 100K and I cannot invest in Bay Area, so I invested in stocks. That's lack of education. And that's where we come in. And that's where all this knowledge comes in. So you have to tell them, like, even if you have 100K, you can invest in real estate. Maybe not in Bay Area, just outside Bay Area. Maybe not in California, in other states. Being part of Keller Williams, you are exposed to this nationwide, in fact, worldwide network of realtors who you can partner with and do the deals in pretty much any state, any major city. If we have time, I'd like to go into the details and do some numbers with you guys. But this is what you have to ask upfront, how much is the cash available, because that can totally change the scenario. Let's say if somebody has $1 million, they are ready to invest. You can also help them invest in Bay Area, right? If they buy a $1.5 million property, putting $1 million down and 500K loan, they will break even or they will be cash flow positive. At the same time, they will have very strong prospects of appreciation because it's in Bay Area, right? However, if it is me, I would say I would buy 5 properties in Sacramento that will give me $5,000 to $7,000 consistent cash flow from day one, rather than betting on appreciation in Bay Area. Because what if this year is year 2007 and next year is going to be 2008, right? The reason I say this is, if I'm solely betting on appreciation, what if the prices drop by 25% next year? And my goal is to get some returns in the next maybe 3 years. But if I'm cash flowing today, I do not care whether property prices drop by 10, 20, 30% tomorrow. My renters are still paying the rent. I'm still getting the positive cash flow. I'm in no urgency to sell. I will only sell when my property price is way above what I bought it for. Okay? So depending on their cash available, their risk tolerance, we can suggest them whether they should go more for appreciation or more for cash flow or a combination of both. I personally like to invest where I, just like I said, at least break even, but at the same time have prospects for appreciation. I don't like to invest in Midwest where a 100K property today would be 110 after 10 years. It didn't even catch up with the inflation. What would I do, right? Okay, and then we dive into numbers and we do some analysis and create a winning strategy for our investors. So the very first thing is buy box. This was a term, I think, invented by one of the investors. He's in Bay Area. He also moved from tech to be a full-time real estate investor. So define your buy box, which basically means your buying criteria. You have to decide what area or neighborhood or cities you want to invest in. I suggest just don't look all over the place. You will end up in analysis paralysis. Maximum 3 areas. Even I think 3 cities is a little bit too much. Maybe pick 1 or 2 cities and then 3 or 4 neighborhoods within those cities. And then property type, whether you're looking for a single family. I'm personally not a fan of condos, but if somebody wants to buy all cash condo, I'll help them. But I'm personally not a fan of condos because there's so much dependency on the HOA. Not much in your hands, and you don't even own any land in it. Townhomes are okay, but it depends case by case basis. Property type, whether you are buying a single family or you're buying a multifamily. Within multifamily, are you buying a smaller multifamily, which is 2 to 4 units, which is still considered residential from financing point of view, or it's a bigger multifamily which is more than 4 units, which is considered commercial. Location specifics. Are you okay with buying near, let's say, a strip mall? Are you okay buying near a busy area, near a factory, near industrial area? And then what kind of rental? Are you planning to do just the traditional long-term rental where you bring in a family and you make them sign a one or 2 year lease? I don't know if you can have a 2-year lease, or a midterm rental where you buy something near a hospital and you have traveling nurses, or a short-term rental where the house is by the beach or by the ski resort and you're doing short-term rentals. So all those questions you have to ask them to create a winning strategy for them. Then, do they just need to buy with you or more? Again, this kind of blends into what is their motivation. Anybody knows what a 1031 exchange is? Could you please explain? I'll go get my boba. Go for it.
They sell property they have, buy another investment property, and then have to pay taxes on the profits first.
Right.
They take that profit from here over to another property.
Everybody got that? So let's say I bought this property for 500K 5 years back, and I'm selling it for $1 million. Let's say roughly 100K is the transaction cost, closing cost, or the selling cost. Then I have a 400K of profit. Now I might, if I'm taxed at 25%, they're going to charge me 100K in just taxes. I don't want to pay taxes. So then there is a provision called 1031 exchange, in which you have 45 days to identify a like-kind property to invest those proceeds in. So you want to invest at least that 400K into another like-kind property. Of course, you can buy it for even 2 million. It has to be at least 400K. And the definition of like-kind is very vague. Like, I've seen people selling a single family home and buying a strip mall. So that's up to the tax professionals, not me. It's what? It's fine. Yeah, they prove it a like-kind. Yeah.
So you said 45 days from when you close on the first sale
to identify, and 180 days to close.
Okay.
Yeah.
100 days.
Yeah, 6 months to close. Yeah. It should be that the next deal should be closed within the 6 months of selling this one. If the contract cancels, good question, I don't know. Yeah. I think you have to close.
45 days.
Yeah, exactly. If you identified it on the 40th day, but after 2 months this one cancels, then probably you're out of luck. I don't know.
Another question though. If I identify the property within the 45 days, but it didn't go through, like I changed my mind, what happens then?
Yeah, that's similar question. Same. Yeah, I don't know.
Is there any provision in the contract that you ask for? It cancels, you ask for
I think we
reimbursement?
are changing into a tax deferral class, but I have limited knowledge. We should bring in a CPA, a realtor or a real estate investor friendly CPA. Travis, please make that happen. I actually know one. I know one. She did a class in, no, she's not a CPA. She's a 1031 exchange expert. I'll probably connect her with you and Eric. She was awesome. Like, she blew my mind away. Okay, I'll give you a quick tip. This is probably worth sitting this entire class. I didn't know it all these years. You can double dip on this. If you have, listen very carefully, if you have a primary home and you have more than, if you're married filing jointly, then it's 500K. If you are single, then 250K. But let's say you're married filing jointly and you have equity gain of more than 500K. Let's say 700K. Don't sell it as soon as you move out. Rent it for the next 2 years. If you live in it for 2 years in the last 5 years, and then you rent it for the next 2 years, this property qualifies both as a primary residence and as an investment. So let's say when you lived in it for 2 years and then you rented it for 2 years, then you sell it in the 5th year and the equity gain is 700K. That 500K is tax-free because it was considered as primary. The next 200K you can execute a 1031 exchange on, literally pay no taxes. But you have to rent it for a while. So she said there is no set guideline on how long you have to rent it for, but she said 2 years is pretty safe for the CPS to defend you. Don't rent it for 2 months and then try to claim it.
And you live in it. Here, and you live in it for.
But the rental has to come later for the 1031 exchange to be even effective. Now, because if you live after, then it's your primary first, right? So,
Not the rent.
yeah, because for 1031, it has to be like rented up till recently when you are selling it. Yes, that's what I think.
On that $500,000 provision, isn't the maximum 5 years? Like if you own your home for 25 years,
Yeah.
you're not going to qualify. Is that kind of how that works?
Now, you should have lived in that home for at least 2 years in the last 5.
So they own the home 25 years, moved out, you start renting it, bam, now it starts qualifying.
Yeah,
3
you
years.
have 3 years to still avail the primary home equity gain tax benefit. Yeah, I tell my clients, like there are so many clients who have moved up. I tell them, we are either selling it in the next 3 years or don't talk to me for the next 10 years, because then you want to justify the tax gain that you lost, right? If you had the 500K and if you're taxed at 30%, you just lost 150K. So, sure. So let's say a friend couple of mine, they bought a single family home, they lived in it for 2 years, and then they moved out. So let's say they bought it in 2022, and they lived for 2 years up till 2024, and then they moved out. I tell them, you have up till 2027 to sell it to avail the primary home equity gain tax benefit. If you don't sell it till by 2027, you're going to lose all that tax benefit.
Why?
Because you have to stay in that home for at least 2 years in the last 5 years.
Ah,
If you go into 2028, you moved out in 2024, so you did not live in it for 2 years in the last 5. From 2023 to 2028, you lived in there for only 1 year. So either we sell it by 2027, or you hold it so much more longer that the tax gain that you lost is made up by the equity gain. So that's what I tell them.
1031 exchange is tax deferred. You're just deferring the
1031 exchange is no limit. Yeah, you can keep renting it. Whenever you decide to sell, just make the proceeds go into 1031 exchange.
Tax.
Yeah. So that's what the the big investors, what they do, 1031 exchange tax deferral throughout their lifetimes and then will it to their kids. So nobody ever pays taxes. We are not going into that though. And I'll edit that part.
And you lived it for 1 year, moved out. Then again after 2 years, you again went back and lived for 1 year. Does that count 2 years?
2 years in the last 5 years. Doesn't have to be continuous. By the way, this is not legal advice. I'm not a qualified tax professional. Disclaimer, like in the footer. I'm just telling it from experience and what I hear from people.
Would it have to go to another property?
Like kind, yeah. It could be a sell a single family, buy a multifamily, sell a multifamily, buy a shop, buy a pizza shop. I think they all work. Okay, and then there is opportunity zone. Opportunity zone is a piece of land or an area which is identified by the government as having below certain minimum number of people employed per square mile. If you invest in any such area, your equity gain that you got from your home, you can invest in an opportunity zone and not pay any taxes. Mostly opportunity zones are not very attractive investments because it's kind of area where there's not many people. That's why it's opportunity zone. That's why government wants you to invest there. And there's somebody always trying to build there because they're also looking for tax deferral. They probably are trying to save taxes on some millions of dollars from a 100-unit apartment complex that they sold, and they're building in an opportunity zone, and they are seeking more money from investors like you. Having said that, I could not believe when last year I bumped into a development in Fremont downtown, which was qualified as opportunity zone. So there are those as well. So apparently in that particular area, there was not enough employment because it was just large pieces of land. There was like a mall which was not very popular, and there was a movie theater where nobody went and stuff like that. So it was opportunity zone. So anyways, so let's continue. We are deviating the topic. And then your team. You need to have a team in place to execute this, to help your investors. You definitely need an investor-friendly lender. All lenders are not the same, just like all realtors are not the same. All lenders, just like all realtors cannot strike a conversation with investors, all lenders can also not strike a conversation with investors. So you need to have an investor-friendly lender on the team. If you don't have one, you can ask me. Contractors. The area in which you are trying to help people invest, have some contacts where you can help them add value upfront. I never buy new builds as investments because I think they come at a premium. I'm already paying for what a like kind older property would be worth 2 years down the line. I'm paying for the new one right away. I always buy properties which are in need of slight to medium rehab. Why? 2 reasons. Because I don't want to pay the top dollar, so my rent to price ratio could be better, and I want to add some equity upfront. If done properly, if you put $2, in my opinion, if you put $2 towards a rehab, it should return you $3. Okay? So if I put, let's say, 50K in rehab of a property, I want its value to go by at least 75K. So if tomorrow or next year, if the property prices drop by 4 or 5%, like in year 2022, I forced that equity. So now I am back to my break even. Ideally, I like to do that, but sometimes I just get screaming deals where the rent is so high, I'll say I just buy this turnkey because the numbers make sense for me.
Also, there's less competition for property that we have.
Right.
Because if there's a really good property, you
Yeah.
get like the offers with 500K above the asking price. You're not going to get that.
True.
As opposed to like,
Yeah.
slightly some repair, you know what, I'm like, that's 50. Like,
Yeah.
No time you get that.
Exactly. So that's a really good point. There will be less competition from primary home buyers. Mostly it will be investors. And there will be less competition from investors who are only looking for turnkey, like our people who are sitting on tons of stocks in Bay Area. They just sell their stocks, buy a turnkey. They will mostly buy like a new build and then they just rent it out. A property manager. Property manager is not required, but I highly recommend them. I see a value in the property manager. It's such a thankless job, in my opinion. I mean, they get beaten up by both sides, from the owner as well as from the renter. So more power to the property managers. You have been a property manager, right? So yeah, you know much more than me. But I really, really appreciate all the property managers out there, and I really feel for them. And I also see the value in me not taking calls from the tenants at random hours. And I also see the value in them in the sense that I do not want to limit myself to 1 or 2 or 3 or 5 investment properties. I want to continue to buy investment properties for the rest of my life. So I would partner with a property manager where we have some chemistry, and I just tell them, hey, I'm buying this property, you are getting it. I know your process, you know how I work, just take it over. So there's value in that process, right? So, and just see your time. You are a realtor based in Bay Area. Is your time more better valued helping your clients buy 1.5 to 2.5 million property worth properties here, or taking calls from your tenant who's paying $2,000 a month, right? So make your call. And then other nice to haves a real estate attorney, a CPA, a cost segregation specialist, financial planner. What is cost segregation? I will not go there. But if you these are, okay, so I'm saying a lot of keywords. You can go back home and research. If you are qualified as a real estate professional, you could do cost segregation. And with that, you can do bonus depreciation on your investment properties and save tons of money on taxes. That is a different class again. Oh, that's it? Awesome. And it's exactly 7 p.m. Thank you. I practiced it. I practiced it for the last 2 months.
It's a boba tea.
Yeah, it's a boba tea, right. Any questions so far?
sure you will be bombarded by a lot of questions from me personally.
I'll leave my cards here. Feel free. Yeah. No questions? Awesome.
Yeah, we can talk. I'm gonna want to reach out to you about investing in property.
Most welcome. Anytime. Yeah. And then, as I said, definitely look into helping investor clients. You just open so many more doors for yourself.
Where do you find them?
No, you attract them.
Track them?
Yeah.
How?
By sharing knowledge.
By what?
Just what I'm doing right now. Yeah. So I post videos on social media, talk about investments wherever I go. I now have a little portfolio as well, so I can show it to people. And I've also helped some investor clients, so I tell that as well. And then people are interested in talking to me. It's just about raising awareness that you can help investors. So just start engaging in those conversations. That's all.